Look, I've seen some murmuring about, hey, there's some of this data may be kind of sketchy, it's incomplete, but, you can quibble about it all you want, maybe a tick here, a tick there, but really the underlying signal through all this noise is that the labor market is cracking and inflation is coming down. So to me, that sets up Fed easing next year more than what the market's pricing in. I would just note, the last 7 months, starting in May, we've only added about 120,000 jobs total. 7 months. The 7 months before that was 1.2 million.
Yeah.
Okay. If you add in Chair Powell's assertion that monthly gains are overstated by 60K, then we're talking about minus 300, 400,000.
Negative job growth.
So, it's and all the other sort of concurrent ADP, Revelio, all the other data really supports that. So yes, you can quibble about the reliability of this data, but I think the signal is very clear.
So the market seems to be banking on 2 interest rate cuts next year from the Fed. Powell was a bit conservative and seemed to signal 1. Where are you at in all of that?
Yeah, so I think the market's understating the capacity of the Fed to ease. Again, I'm sort of more worried about the labor market than I think than many in the market. If you look at your WIRP, one of my favorite pages, I think the odds of a January cut are only 25%, which I think is pretty low. I'd say right now, I'd say it's a coin flip, depending and with the deciding factor being the December jobs report that comes out in early January. So we've got another jobs report, another CPI report, 2 retail sales report. That's going to kind of, I think, inform the Fed. But really, the trend is there. The labor market's cracking. To Lisa's point, there's so many companies that are starting to talk about weak outlooks for sales, consumers cutting back. I mean, that's going to happen if the labor market's cracking.
4.6% unemployment rate. That's still pretty good in my mind, but what's underneath that concern?
Yeah, so I think you have to see where we came from. Remember, we bottomed at 3.4% back in 2023.
Yep.
This whole debate about whether the Somme rule is still in impact, because we're pretty much double what the Somme rule would say in terms of recession. But I think most people's base case is that we have no recession next year, and I'm on board with that. But I do think we have some slowing growth. To me, the big issue for next year is, can the AI investment boom offset what I think is coming a significant slowdown in consumer spending? That's to me, $1 million question. I think it will help offset it, but I don't think it can totally overwhelm this. The consumption. Consumption is 70% of the U.S. economy. Fixed asset investment is about 20%. So it's hard for this investment boom to really offset a big consumer slowdown.
So if the labor market is your biggest concern heading into the new year, how concerned are you that we might slip into a recession?
Yeah, so again, I think that's a risk. I think the market odds of a recession, something like 25-30% odds. I think that's probably right, maybe a little bit high. I do think that there is enough momentum in the U.S. economy to kind of keep going. I just look for a slowdown. A few rate cuts from the Fed can't sort of help. I'm looking for at least 3, maybe even 4 cuts next year. The dot plot, as you point out, at 1, which is to me just kind of silly. We know inflation's coming down. A lot of the tariff stuff is the year-over-year stuff will kind of fall off, the base effect. We know the labor market's cracking. So again, you can always kind of poke holes at what the Fed is saying, but they're looking for 4.4% unemployment in 2026, 4.2% in 2027. I'm not sure how that happens. Unless we get
without
a real acceleration.
A little bit of help.
Yeah, we need some help from the Fed. Again, nothing the Fed. I don't think it's panic time. I think they should be sort of front loading these cuts.
How's the consumer doing out there?
Well, Lisa gave us a little hint. I mean, I've probably been hearing this over and over. Yes, guidance for next year is concerns, consumers cutting back. I'm sure you've seen all the statistics that the bulk of retail, the consumption retail sales is being driven by sort of the high 20% sort of income bracket, whereas something like 60, 70% of the economy consumers, the lower income consumers, are struggling. We know that. That's why we're talking about affordability. For us here in this room and our listeners, we're feeling pretty okay. But really, for the majority of Americans, I think they're struggling with the inflation. Now we're getting these layoffs, tepid job growth. So it's a struggle. It's that whole K-shaped economy that we talk about. And I had this debate, is that upward K enough to offset the downward part of the K? And, that's, to me, a big question for next year.
So then where do you see, I guess, strength in the economy next year? I mean, if it's not going to be the consumer, if it's not going to be the job market, where do we see sort of because the consumer has been the pillar of this economy for so long, right?
Always is, yeah.
Who sort of, who or what provides a foundation, if you will, for the economy?
Yeah. So you go back to Econ 101, you got C plus I plus G plus net exports. So consumer, cutting back. G, in terms of government spending, cutting back. We've given out some tax cuts, obviously, under the big, beautiful bill, but actual government spending is going to be, I think, a net negative next year. Net exports, that's a tough one, given that, with the ongoing tariff war. So it's really up to investment. And again, I keep pointing to AI. That's been a big driver why headline growth in the U.S. has been so strong. It's all this investment in energy, chip production, all that. Can that be sustained? Is that enough to offset, again, 70% of the economy? Again, I don't think it can totally offset, but it'll kind of cushion the blow. And again, the Fed starts cutting rates. We get some maybe life in the housing sector, which has been really under pressure. Yeah.
Yeah. Speaking of which, what is your outlook for the housing sector?
Yeah. So we had this nice drop in mortgage rates, as the Fed was cutting, but now they've been kind of sideways. And you look at some of the housing data. Well, unfortunately, we haven't had a lot of the housing data because of the shutdown. It's starting to trickle out, but there seems to be some sort of modest recovery underway. But again, I think the important thing, and this is I think what the Fed is puzzling with, is the Fed controls the short end. What's going on with the long end? And the long end has kind of stayed elevated. And we need to get the long end down to get mortgage rates down. And we could spend an hour or two talking about that.